Hello and welcome to this edition of Credit Matters TV. I'm Michela Bariletti and I'm the Analytical Manager of Project Finance in EMEA. I'm delighted to be joined today by Michael Wilkins, the Managing Director in the Infrastructure Group, to talk about the recently published article, Out of the Shadow, the Rise of Alternative Financing in Infrastructure. Mike, welcome.
Thank you.
Maybe if we can start on defining what we exactly mean by shadow banking.
Sure, Michaela. Well, shadow banking essentially is everything outside the normal realm of commercial banks or regulatory depositories or the typical bond investors that we see in the public markets. So in other words, the shadow banking sector, which is also known as the alternative funding or financing sector, includes pension funds, asset managers, insurers, export credit agencies, and so on. Basically non-regulated entities in the financial sector. That's grown considerably over the past few years, mainly for regulatory reasons, but essentially in the infrastructure world, the shadow banking sector is having a big influence very much at the moment.
Right. So what has been the impact of shadow banking in project finance so far?
Well, so far we've seen a rise in shadow banking providing funding for infrastructure over the past few months to quite a large degree. If we take the project finance market globally, it's around $200 billion worth of finance, mainly from the banking sector. If we look at the US, for example, around a quarter of that is provided by the banking sector. And again, around a quarter of the banking financing is provided by the so-called shadow banks, the alternative sources of funding, the pension funds, the insurers providing private placements and so on. So if we extrapolate that forward to the current year, we expect somewhere in the region of $25 billion worth of funding coming from the shadow banking sector for project finance.
Right. And how is Standard & Poor's actually addressing this risk?
Well, it's not so much a risk, it's so much an opportunity, actually.
Right.
We think it's good that this source of funding exists for infrastructure because there's huge infrastructure needs globally. And the capital markets, in terms of the public bond markets, are only just now starting to re-emerge for project finance. But the emergence of shadow banking and pension funds and insurers providing all this capital is actually going to expand the amount of projects which are actually funded in the private sector. So that's a good opportunity. But at the same time, we have to be conscious of the risks. For example, if shadow banking grows in a very fast way, it could lead to a bubble of financing, such as we saw pre-2008 with the infrastructure funds and the highly leveraged acquisitions that we saw in infrastructure at that time. So that's a concern. The other thing, of course, is that the investors coming in as part of the shadow banking sector don't always have the necessary resources to deal with all the risk analysis that's required in project finance. And that's principally true of construction risk, which is a major issue. So far, we've seen the shadow banking sector shy away from construction risk because they don't really feel comfortable with it, or maybe they don't feel their returns are commensurate with the amount of risk they're taking on. We have just launched our new construction risk criteria, which we believe will add a lot of value to investors, both in the conventional and in the shadow banking sector, in understanding these risks in construction. And if you understand construction risk in project finance, we believe there's an opportunity there in terms of understanding the whole profile of your investment and also adds more to the opportunities available in this market.
Right. Thank you, Mike. This concludes this edition of Credit Matters TV. Thank you and goodbye.